Bitcoin climbing above $100,000 for the first time as the crypto rally continues. Joining me now, Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager. Great to have you here with us this morning and back on the program, Joanne. Just first and foremost, let's start where we left off here and the crypto trade right now. How would you be playing it? What type of risk exposure makes sense for an individual's profile with crypto notching this new milestone?
Well, good morning, Brad. The crypto trade clearly is one that reflects a lot of enthusiasm right now for risk. And in that way, it's a real signal as to what also might be going on in equity markets. And so overall, it's a useful sign that the risk on trade continues. Our focus for our clients is to invest in equities and also bonds, but crypto is its own asset class. It's probably best seen as an alternative to gold. It hasn't provided the sort of hedge against inflation that some people originally thought it would. In fact, if you look at the history, it is actually not correlated in the way you'd expect. So when you're thinking about crypto, you really have to think about it as a risk play. And there's a lot of momentum behind that, and that's proved to be very useful for those involved. The other way to think about crypto is that in developing countries, in less developed countries where the currency simply is not reliable, it can be a very useful way to transact. So we're seeing more of that. The high price of crypto actually creates a headwind for that use case. So it's sort of a mixed bag. And obviously there aren't, fundamentals underpinning the value of crypto. It's really momentum and speculative risk. So, investors that are interested have to recognize that's kind of what they're buying into here. And obviously the price has gone up a lot. And when you want to compare it to equities, look at other things that have gone up even more. I mean, look at NVIDIA this year. It's up 193, 200% more over the last full year. So this year, NVIDIA has done better than crypto has. And at least with NVIDIA, you've got some real fundamentals behind that. So you don't want to look at it in isolation.
Certainly. And so as you're thinking about then in equities, some of your favorite places in equities, especially coming off of the record highs that we had mentioned, we had notched yesterday as well in the S&P 500 notching its 56th record close. And then, of course, with the Dow Jones Industrial Average getting above 45,000 for the first time. All these things considered, where does it seem like there is still more room to the upside for equities, and where are the most attractive positions from your perspective?
Yeah, Brad. So obviously we've seen a lot of appreciation across the board. And, beginning of the year, it was all the tech space and consumer in the big players. But then, you notice about halfway through the year, things really started to broaden out. And the reason for that, and I think it's a reason that continues to be relevant today and into 2025, is that the broader economy proved to be stronger than most people, I should say, expected it would be. And so we saw a rally coming from the fundamentals, better earnings, better sales, good solid profit margins that really helped carry the rest of the market beyond the big seven. And that's something that we, in pockets, can expect to continue. The economy remains strong. Inflation is under control. We have to, though, be mindful of how policies could change with the incoming administration. And instead of looking at how the whole market might react to that, it's really important to look under the surface because those policies will have more industry-specific and company-specific effects. So I think the time is really ripe to shift away from index investing and be far more attentive to how individual companies might do under these potential new policies.
With that in mind, it sounds like, looking at where the portfolio should also get defensive in the face of where there could be some volatility that does initiate on the back of policy from the incoming administration, as some of that is starting to be telegraphed right now. I wonder where those areas for a defensive mindset are really starting to brew for you and your team.
Yeah, so one area to look at is the consumer. We've already seen a real bifurcation of consumer health and spending, right? The lower end, middle end of the income distribution has really struggled with the cumulative effects of inflation, with prices really squeezing their budgets, and we've seen that come down to hurt the low end of the retail space, like a Dollar General, for example. and that ilk. And what we've seen do well are ones more in the middle, the off-price retailers like a TJ Maxx, for example. And so we still think that's a good place to hedge the risk to the consumer, whether it's from higher tariffs that may be coming down the pipeline, whether it's from constraints on immigration and foreign labor, which could drive up costs, particularly in agriculture or construction and that sort of thing. So, those companies, those retailers that offer value but quality. And I'd even push it up to a little bit to the higher end of like a Williams Sonoma. They offer affordable luxury in their flagship stores and online, obviously. And then the Pottery Barn, which offers more reasonably priced furnishings and that sort of thing. We still see housing as a good opportunity, even though rates look like, they may not fall as much as folks hoped. But moving into a new home, a new apartment, creates the demand for the sort of thing that Pottery Barn sells. And we've seen that materialize in the quality of earnings that Williams Sonoma has been delivering. So look at the consumer, look at the details. What is happening to their budget constraints, and where are they choosing to spend?
Joanne, thanks so much for taking the time as always. Great to have the conversation here this morning. Appreciate it.
You bet.